Hey everyone, it's Doug the Retirement Guy, and I'm going to give you the Retirement Income Education series I've been building. We've been doing this over the past few months, putting things together, and I got another edition for you. And really, I question this: is why wouldn't I retire on yield alone? So many people talk to me, and we do, through our Patreon, we have that one-on-one coaching side of things. And so many people talk to me about, well, I'm getting this yield, I'm getting that yield. And I always question that and come back with why I wouldn't retire on yield alone. So I'm going to answer a lot of people's questions and comments about different things of how the yield is the most misleading part of any ETF. High yields can look like retirement paychecks, but they're hiding something far and more dangerous than ever before. So let's get into today's video. And before I do, I got to do a shout out. Because this comes from all of our Patreon supporters, I got to give you guys a giant thank you for helping out and doing what you do. Also, all of our YouTube subscribers, we are well over 15,000 on this channel and our other channel doing just as well. So we're well over 45,000 subscribers. Thank you all so very much. Let's get into today's video. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So yield is not the whole story. Okay, this is my opening warning to you. Many retirees out there see a 12, a 15, or 20%, and they assume that their retirement check is going to get bigger, stronger, or they're going to stretch their budget out even farther because they're getting such higher yields across the form. But the high yield can be deeply misleading. And it's probably one of the biggest things that happen out there, that yield is so misleading. If a fund is returning your own capital while the NAV keeps falling, the income isn't really real. Okay? It's retirement erosion dressed up as a paycheck. So many people I talk to that will always tell me they can talk yield all day long, but they never can tell me how the fund creates that yield. They can never tell me how the NAV looks. They don't can tell me their total returns. This is why we go over this in our every time I do a breakdown of a fund. We look at multiple different areas. There's about 5 to 6 different areas we really look at before we say, yeah, this fund's good, bad, or ugly. So why retirees love high yield? Well, the appeal is real, but the full picture is what matters. Okay? I know I've done this myself. So this is not something to hammer you and feel bad about because personally I've done it myself. When you look at that big yield, it's the first number that most people present, they advertise, they do a lot of big things with yield, 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 but you got to stop at that point. It's like that giant sign in front of the store. It says giant sale, 50% off. And you walk in, you're all excited, we're getting 50% off, to find out it's only the Christmas items from last year at 50% off. So the retirement income reality is retirement replaces your paycheck. So your Social Security check, a pension, savings, investment income is what you're trying to replace your current paycheck with these type of categories. So on a $500,000 portfolio, the math seems so compelling. If I get 10% in the yield, I'm going to get $50,000 a year. If I get that to 12%, I'm going to get $60,000 a year, which is funny. Those two numbers really is the median number for most Americans when they go into retirement. The actual median number is right around $56,000 a year, and that's what they need to live on. So if you have $500,000, a 10 or 12% is really just covering your nest egg, what you're looking to do. So all of a sudden you start searching, you want more money, you look at, oh, look at this one, 15%. Now you're talking $75,000 a year. So the number up front looks great. And before you jump in with both feet, you got to look at these numbers and say, are these really realistic numbers? So what I tell you over here, you have a paycheck and you're trying to replace your paycheck in retirement. So your retirement fund now has to fill that void of that paycheck. So, you've been paying in for over 30 years probably. Your Social Security is going to help you cover that. If you're lucky to have a pension, that's going to help cut into that. But then the savings and your investment income are all become the major part. That's your piggy bank. Now, if you have a healthier fund with a growing NAV and it's giving you the 10, 12, or 15%, more power to you. Let's get on board, let's live life and enjoy. But if you're getting into a yield trap fund, okay, and it's eating itself alive, then these 10, 12, 15 funds are the worst thing you could do. It's the pothole in the road, it's the quicksand that's out there. It's a yield trap that you don't want to be a part of. The yield tells you what a fund pays, not whether it's healthy or not. Just because someone pays you a nice 12% targeted fund, or pays me, this one's saying 15%, you don't know nothing about that, because yield changes almost by the minute, by the hour. Of if the price goes up, your yield's going to go down. If the price goes down, your yield's going to go up. It's all because it's a mathematical calculation. It tells you nothing about the fund. So what is a yield trap that I talk about? It's when a high income hides a losing investment. So let's put it this way. You invest $100,000 into an initial investment. I don't care what you want to call it. It's just an initial investment you make, and the fund advertises it pays you 15% yield. Sounds great. But the fund loses 20% in value. So what's really happening? You're receiving the income received of that $15,000 from your $100,000 and getting 15%. So they're giving you $15,000. But the account value has lost $20,000. So in reality, you are actually lost $5,000 on this investment. And you felt like you were winning by getting $15,000 from your $100,000 account, when actually you really lost $5,000 because your total return loss was over $5,000 loss. It's not a retirement income. It's retirement erosion is the better word to use. It's retirement erosion. So this is what we call a yield trap. This is what you're looking at. You're looking at big yields, but the underlying part of the fund is losing its shirt. Now, this is a word that you hear a lot from YouTube people and people putting things out there. And so many struggle knowing exactly what this is. And it's called NAV erosion. It's the silent killer of any fund. When your fund's value quietly disappears beneath the income. Okay? So really, what is NAV erosion? Well, the NAV, which is net asset value, is the per share value of the fund's underlying assets. When the NAV persistently declines year after year, the fund may be paying out more than it earns. Okay? It's not that the fund dropped today and it came up tomorrow, or it's not that it dropped 3 days and then it flattened out. Those are what we call market corrections, market adjustments. But when you see a fund over time, and I always say 6 to 8 months is a great tracking system to find out, do you really have NAV erosion? Now, you all want to know this ahead of time. So you can do more research, and I'll explain to you where you can already tell a fund long before NAV erosion kicks in. You can tell if a fund is doing good, bad, or ugly with a whole different number. So the strategy is too aggressive. What happens here is the strategy that becomes too aggressive and gives up too much upside. This is what we call the capped upside potential. You see this a lot in covered calls. So what they do is a covered call, they put a ceiling on how large the fund can actually get. Okay? Because if it gets any higher, people are going to buy your fund, sell it, make money onto it, and you're losing your money. Payout is more than the fund can support, which means they're paying out more dividends and distributions than they're actually collecting from their funds. And it works in one market and struggles in another. So if you have a bear market, it's doing great. If you have a bull market, it's struggling like crazy. There's actually a third market right in the middle, is that uncertainty market, which I really feel we're at right now, is that uncertainty. There's a lot of volatility. There's some ups and there's downs. They're all waiting for the good news, the bad news. And that is where it works the worst. Now, distributions funded by your own capital, what this is when they don't make enough money, they do what they call ROC, return of capital. Now, return of capital is a double-edged sword. It can be a good thing and a bad thing. Now, the good thing is they're going to advertise it. This is how we handle our taxes. This is how we handle, you're kicking your can down the road of your tax side of it. But what happens is the ETF negative side of it is they can keep their yields up. They can keep their distributions up because technically we gave them a law, we gave them the rules, we gave them the opportunity to give us our capital back as distributions to say, yep, your return of capital. This is how a fund gets in trouble. And this is why you see so many people out struggling with different things. On the chart here, you see at 1 year, the NAV was $25. Second year, the NAV is down to $21.50. The third year, down to $17.80. There's your NAV erosion over 3 years. The net asset value keeps dropping and dropping and dropping. Now, there's multiple ways of seeing it, and I use it. Every one of my reports I look at the assets under management. Has it gone up, down? Which way is it going? But then we're also looking at the total return side of things as well, and we'll cover that here shortly. So the income keeps coming out, but the value keeps leaving. This is a yield trap. This is a negative driving fund. It's don't only ask what it pays. You have to ask what's happening to the value of the investment, which is another reason why I never invest in a brand new product. I always wait 6 to 12 months before I invest my money into it because I want to see what is actually happening. So this is where we start. Yield is not the same as return. So many people get that wrong. They will come to me and say, I'm getting 14% return on my investment. I said, really? Let's take a look at it. And they always point to the yield. Yield tells you what you received. Total return tells you what you keep. This is where I tell everyone to first start at. You can look at yield and the income paid out by the fund. And it does not account for price movement or anything. It pays a 14% yield. But the NAV has dropped 10% off over the past year. Okay, this is the first fund. This is where someone says, I'm collecting 14% of my money, I'm doing really good. And when we start to break it down and I show them the total return number of a particular fund, they don't even know what to answer because they didn't know what they were looking at. Total return is the magic number that tells you about a fund right off the bat. So before I invest in anything, I always run immediately to the total return. How is it done in the past month? How is it done in the past year to date? How is it done in the past year? How is it done since inception? This is so easy to do and just as easy to look at yield, other than you got to click a couple more times on most of the financial websites. So if you took a fund B and it only pays an 8% yield. Now, some people will say, that's not even enough for me. I can't handle 8%. But what happens is if you take the income plus the price movement plus the reinvestment of distributions, the complete picture of a portfolio's performance totally changes. So as I put here, Fund B pays an 8% yield, but the fund grows at 6% in the price. Now, to get that 6%, yes, you're going to say, well, you have to sell it, Doug. You're right. But together, we grew our portfolio by 14%, while your 14% yield you actually lost 10%, which means you only gained 4. So which fund is actually better, Fund A or Fund B? Okay, so total returns are so easy to check out and look at because retirees need income today to pay their bills, but you also have to have growth to fight tomorrow's inflation and changes in the marketplaces. So here are 2 funds I love to share with you this one. And this one was all over YouTube. I was part of it. We were promoting, not really promoting the fund, but it was one of those funds I was watching out because it was so interesting. But the Yield Max Ultra Option Income Strategy. Now I know majority of people have bought this when it was first out, really big. The yield advertises 112%. So how could that be a failure? 112%. Think about that. What it's saying is if I put $10,000 into it, I would get my $10,000 back plus another $12,000. It's huge that I'm going to get 112%. Now we have the NASDAQ 100 ETF that only pays a 13.57%. Now I've covered this one over and over, and you probably know, yes, NEOS is a very, very strong product. But look at the chart. This was just one quick chart that I did in our stock analysis account. And this is the free version. This is not the paid version. This is 100% free. Okay? Look at what the 2 funds have done so far in over the past 1 year. Okay? They've both been active. They've both been, so it's an apple for apple comparison. At the beginning of July 25, ULTY was actually had a higher total return. It was having growth. And then here we hit late October, early November, and it dropped off. This is the brown line I'm talking about. Look how it's dropped down. This fund is actually a negative 0.19% total return. So what does that mean? That 112% yield of your money is eating away by NAV erosion. Your portfolio is getting smaller and smaller because when this number is negative, that means it's taking your money away from you for nothing. I call it a slot machine. You're putting your quarters in the slot machine and you're pulling the handle. And I hope that was fun for you because that money's gone. And that's the same thing here. You can see the fund was all the way down to a negative 15% total return. That means it was eating 15% of your portfolio. Now we switch this over to that little 13.57% ETF. Look at where it's at. Now market conditions have caused this, and you can see the lines, but the blue line always stayed in the positive mark. And as of today, they're looking at 24.92% total return. So you take the yield, and this is the simplest thing to do. Now it doesn't always mathematically work out to the T, but it's an excellent, I always call it get you on the green type situation. 24.92, take away your yield of 13.57. That means you really have about an 11% growth in your fund. Okay? So this is just a quick number. Now don't hold it to the T and say, Doug said this is growing by 11%, and I just checked it and was only up 9. It's just how a quick, simple math you can do in your head and say, wow, 13.57% yield, it's up 24.92% over the 1 year. That means it had 11% growth. That means your fund underlying assets are getting bigger and bigger and bigger. The company is doing it to grow market share. They're trying to grow their portfolio. ULTY is losing 0.19%. So where would you put your money? In the 112% yield or the 13.57% yield? The answer to it is Yield Max, ULTY, is a yield trap. It's a 100% yield trap. Hey, I got to put a shout out to you now. Doug the Retirement Guys, this helps support the channel. This is why I do this. We don't take sponsorships. We don't do anything to drive business because we're not looking to promote other people's stuff. I want to be upfront and honest with people. And what we have here, we came up with, and people have been loving. I'm telling you, thank you so much for everyone who has ordered them. They're flying out every single day. But we came up with the Retirement Made Easy, Living on Dividends, the Doug the Retirement Guy mug. It's only $8.99 plus shipping. You can use the QR code. Everything that comes in helps support the channel to keep doing the videos like you see. If you need a coffee mug, hey, I'd love to see this on everyone's breakfast morning table. But it just helps us along. So I just wanted to put it out there. Easily simple. I put it down in the description. You can go to the link to get it, hit the QR code, and we'll get you a coffee mug. Just to tell you, we're like on our third, I believe we just placed our fourth load already of coffee cups to get it out to all of our supporters. We thank you if you've ordered it. And if you haven't, what are you waiting for? Help us out. Buy a coffee mug. Hey, the common retirement income mistakes that we run into, chasing the biggest yield can quietly destroy your retirement. The yield in the first, if you go by yield first, you're going to be chasing it. You're going to be really into a yield trap because everyone's always going to look at that 15 to 20%. Man, that means everything. Select funds based on yield alone ignores NAV erosion, strategy quality and changes, and you want to find that true return. The no stress testing, skipping the hard questions. How is the yield generated? Was the NAV stable? How did it perform in both a bull and bear markets? Those are all the questions you have to ask before you invest your hard-earned money into anything. Okay? And then ignoring the tax implication, overlooking tax treatment. Distributions may be ordinary income, qualified dividends, return of capital. Remember, double-edged sword there. Or Section 1256 long-term contracts. In taxable accounts, this changes everything. Not so much in the IRAs, not so much in the Roth, but in your taxable accounts, which most of us will end up with in retirement. This is a huge factor. So a high yield ETF must be inspected and stress tested, not given a free pass or a monthly income guarantee. So you really got to do some stress tests before you buy into this. So return of capital, is it good or bad? Well, we're going to do another video on return of capital to help people understand it. I think it will be our third one that we've done, but really going to ask that question, is return of capital really good or bad? It's that double-edged sword. It depends entirely on what happens to your NAV. So if the ROC can be smart, and I always say if the company uses it properly, the NAV is stable and growing, it reduces your cost basis, it defers your taxes, and part of a deliberate strategy. It's a positive thing. But if you have an ROC, can be a warning sign across the board. If the NAV is steadily declining, if the fund isn't earning enough to pay the distributions, or you're getting your own money back, you have high income plus failing NAV, which is retirement erosion. Okay, so the real question is the fund maintaining its NAV while making distributions? Having ROC is not just the immediate say, I don't want it, I'm done, I'm walking away. It's a great piece, but it also gives a license to basically lie or hide the quality of a particular fund. So a 5-part evaluation framework. I put this together to help people on our channel. I've done this numerous times. Don't just buy yield. Understand the machine and understand the process that you're going through. So number one, yes, is yield. Is it sustainable? Is it reliable? 7 to 12% beats a destructive 20% all day long. 2, your NAV stability. Is the fund holding value or quietly shrinking year after year? 3, total return. Income plus price movement plus reinvested distributions is the big full picture. Okay, so you really got to take a look at number 3. I know should be number 1, but number 1 is always you're looking at yield. That's the first interesting part. Then it asks all these other questions. How's the NAV? What's the total return? Number 4, what's the strategy? How does it generate the income? Is it doing it through covered calls, options, pulling out point blank just dividends, or is it also how is it dealing with that tax side of it with the return of capital, which is actually number 5, the tax treatment. In taxable accounts, is it ordinary income, qualified dividends, or ROC? All of it matters because if you got to give up, I always use this one that someone once told me, and I think Warren Buffett actually said this too, but it doesn't matter how much money you make, it's how much money you keep. How much money you keep in your pocket? How much money do you get from this? And if I make, 10% and I got to pay 15% to the government, I didn't make 10%. So it's all 5 of these points you have to look at before you invest into a particular fund just because it says it has a high yield. So a better approach, I always use the bucket system. If you haven't seen it, I've done videos on this. It's a 3-bucket system. 3 different jobs, 1 retirement that really, really lasts. We have our safety bucket, which is called our foundation bucket. We have a growth bucket. We have an income bucket. The safety bucket is for that market storms, cash, money market funds, short-term bonds, some long-term health growth funds. You'll see things in mine that are 10 to 20 years old already. Growth bucket. This is going to be growth-oriented investments, equity exposure over time, builds long-term purchasing powers. And when we rebalance, each bucket goes to the next bucket, to the next bucket, to make sure every bucket is maximum full. And our income bucket, which everyone always jumps on first, is the one that's going to give you your income from your ETFs, your dividends, covered calls, option strategies. It's built around sustainable yield. But if you don't do your research and don't build the other 2 buckets first, you are going to have a guaranteed problem. So quickly, Fund A versus Fund B. Which fund actually builds retirement wealth? Well, Fund A has a 16% annual yield, but it has a decline over the year of 12%. So realistically, you're getting a total return of this particular fund. You receive income, but you lose more than you earn. Okay? Versus a fund that pays 8% and has a growth factor of 7, you're growing your fund bigger with getting a true hardcore return. So this is what you want to make sure. This is how the math comes out when you take a look and put this on paper, what each fund really looks like. So the final takeaways and the steps I suggest everyone always follow when you're building a smart retirement engine, not just the biggest paycheck, ask this first. 1, is the NAV stable or growing? 2, is the total return strong? And is the income truly sustainable? You believe none of those I actually said was yield. 1, is the NAV strong and growing? Is the total return strong? And is it truly income? The valuation beyond yield is unsustainable and not impressive. The NAV stability, the fund is holding or growing its value. Total return, income plus price performance combined, what is it? Strategy, and of course tax treatments. Guys, let me know what your thoughts of this. We're trying to help everyone out. We're trying to answer a lot of different questions. If you have anything, leave a comment down below. I'd love to hear from you. And if you like what we're doing, hit that like button. And best of all, if you want to help the channel, don't be afraid to order your coffee mug. It's simple, it's easy, and we'll give them right out to you. Thanks for watching. We'll see you at the next one.